7 Smart Ways to Raise Cash Fast. How to get money when time is of the essence. Whether you are facing an onslaught of unexpected medical bills, you recently lost your job, or your home has been hit by a hurricane or other natural disaster, one thing is certain: you need cash and you need it now. Unfortunately, when a financial emergency crashes into everyday life, the vast majority of us are caught completely unprepared. If you find yourself in this fix, you are not alone. About 6 out of 10 American households experience at least one financial emergency a year, and about 1/3 of American families have no savings at all, according to FEMA. 1. And almost 40 of Americans would have trouble paying for an unanticipated emergency expense, such as a $400 car repair, according to a report from the U.S. Federal Reserve. 2. If you need quick cash to cover an urgent expense, where do you turn? Here are 7 smart ways to raise money quickly without causing irreparable harm to your finances. Key takeaways: selling personal belongings, such as clothing, electronics, or books, online may help you raise cash in an emergency. Consider taking on an odd job, such as babysitting, dog walking, or yard work to help bring in extra money. You might consider borrowing or withdrawing funds from your retirement account. In most years, that could mean paying taxes on the distribution and detention penalty. 3. If you borrow money from friends or family, it's best to draw up a contract about the terms of the loan. 1. Liquidate your assets. Does the corner of your jewelry box hold your dad's Rolex, your mom's engagement ring, or a diamond pin you rarely wear? What about goodies tucked away in your closet? Perhaps a fancy bridesmaid dress or your inherited great-aunt's fur coat. One online platform ready and willing to pay cash for your clothes is ThreedUp. In the Help Center, click on the clean-out process to find out how the selling process works. 4. Or you can try selling your clothing on eBay. You also may be able to make fast cash by selling off recent model electronics like big screen TVs, tablets, phones, laptops, and game consoles, as well as media like DVDs, CDs, books, and games on sites such as Declutter, Gazelle, and Usal, and marketplace sites like SwapUp. Or you can try posting them on Facebook Marketplace, Craigslist, and Twitter. Run an ad in your local newspaper, or peddle these pieces to friends and family members. Depending on the quality of the garments, electronics, and media you're willing to sell, you could quickly rake in hundreds, or more, in much-needed cash. 2. Take on odd job. If you don't have any high-value items to unload, you can try selling your services instead, especially if you are out of work and have time on your hands. You might babysit and four-pet, sit for friends, or start up a neighborhood dog walking service. According to ZipRecruiter, the nationwide average hourly wage for a babysitter is $17 an hour, while Pete Sitting pays an average of $14 per hour. 5. 6. Dog walkers can typically earn about $15 an hour, according to PayScale. 7. If you're not up for dealing with dogs or kids, you might offer to mow the grass and wash cars for people in your neighborhood, or drive a neighbor's elderly aunt to her doctor's appointments. Or if you enjoy driving, you might sign up to be a Lyft or Uber driver. According to Gridwise, rideshare drivers' earnings in 2020 depend on where they live, but range from $14.65 per hour in San Antonio, Texas to $19.44 in California's Bay Area. 8. You could also grocery shop for busy friends or older adults, or offer to repair and paint your sister's dilapidated fence. Depending on how many jobs you take on and how much you charge for each task, you could scrape together a few $100 within a single weekend. If you don't have enough people who need work done, try signing up for jobs through websites such as TaskRabbit, Thumbtack, or Skills-based work in Upwork, Freelancer, or Fiverr. An emergency fund can provide a financial cushion to help when unexpected costs, like medical bills or loss of a job, occur. Try to set aside money when you can to start one. 3. Track down your loose change. At first glance, this advice may seem a little absurd, but it's not a joke. According to a 2016 news report from Bloomberg, Americans throw away approximately $61.08 million of coins in the trash each year. 9. That's a lot of money stuffed in couch cushions, piggy banks, and old paint cans across the nation. Hunt around the house to collect all those hidden coins. Once you dig up every last cent, haul the trove to your local bank or credit union. Some banks will count change for free for their customers, although others may require you to count and roll your change on your own. Either way, Once you convert those coins to cash, you could have another $100 to put toward your emergency expense. 4. Organize a garage sale. One man's trash is another man's treasure, as the saying goes. While garage and yard sales require a lot of work, they can bring in a decent chunk of change for some sellers. Be sure to advertise on Craigslist, Facebook, if you have a local group, your local newspaper, online as well as print, and church bulletins, and put up neon signs with black lettering in key locations to bring in as many people as possible. 5. Get money from your retirement account. For more significant amounts of money, the first 4 steps may not suffice. That's when it makes sense to look at your 401. In most years, if you're younger than 59.1, 2, you pay a tenth penalty for withdrawing from your 401 quans, but there are times when it may pay to do this. 3. Also, there are certain exceptions when the 10 penalty may be waived, such as when you have unreimbursed medical expenses that exceed 7.5 of your modified adjusted gross income. 10. You can also borrow rather than withdraw money from your 401k, a better choice if you can manage it. 11. If you don't have a 401k, but you do have an IRA, this could also be a source of funds, especially if it's a Roth IRA. With a traditional IRA, your options are more limited, but even then, there are some situations in which you can withdraw retirement money at little cost to you. 6. Part with your plasma. Now we're getting to the more extreme options. Plasma is a valuable resource used for a variety of medical treatments and research. Donating plasma is similar to giving blood, according to Octapharma Plasma Inc., a company that collects plasma used to create life-saving medicines for patients worldwide. 13. Once your blood is drawn, it's cycled through special equipment that separates plasma from the other parts of your blood. Your plasma is then collected in a container, while the other parts are safely returned to your body in a process called plasmapheresis. Reports vary as to how much you can make, and it will depend on a variety of factors. You could make between $20 and $60 for each donation. According to the Octapharma Plasma website, generally, the more you weigh, the more plasma we can collect, and the longer it takes to donate it. The amount of money new and returning donors make reflects this. 7. Borrow money from friends or family. We save this one for last because it really should be a last resort. While borrowing money from friends and relatives may be a quick fix, it can lead to some adverse consequences. When a loved one lends you some cash, it can put a strain on your relationship, especially if you don't pay the person back quickly. According to an article in Psychology Today, unpaid loans can lead to lingering bad feelings between the lender and borrower. 14. If you plan on borrowing money, it's probably best to draw up a contract stating when you will begin to pay back the lender, and if you will also pay interest on the money borrowed. The bottom line, if you find yourself cash-strapped when a financial emergency strikes, you're not alone. The vast majority of Americans don't have enough cash on hand to pay for unexpected expenses. When you find yourself in this scenario, the worst thing you can do is drive up credit card debt or take out a payday loan, which will have exorbitant interest rates. Fortunately, there are plenty of smart ways to raise money quickly without decimating your finances. Whether you choose to sell some of your belongings, take on odd jobs, or borrow money from a parent or friend, one thing is sure: as soon as you recover from this financial calamity, it's time to start building up an emergency fund. How much cash should I keep in the bank? It depends on your financial situation and budget. Everybody has an opinion on how much cash you should keep in your bank account. The truth is, it depends on your financial situation. What you need to keep in the bank is the money for your regular bills, your discretionary spending, and the portion of your savings that constitutes your emergency fund. In addition to keeping funds in an account, you should also keep between $100 and $300 cash in your wallet and about $1,000 in a safe in your home for daily expenses. Everything starts with your budget. If you don't budget correctly, you may not have anything to keep in your bank account. Don't have a budget. Now's the time to develop one, or refine the way you've planned up to now. Here are some thoughts on how to do it. Key takeaways. How much cash you should keep in the bank depends on your financial situation and savings goals. It all starts with having a budget. The 50-30-20 rule and financial guru Dave Ramsey's method are two popular approaches to budgeting. Both provide a blueprint to allocate money to your regular bills, discretionary spending, and setting aside a portion of your savings for an emergency fund. 1-4. How much cash to keep in the bank? The 50-30-20 rule. First, let's look at the ever-popular 50-30-20 budget rule. Senator Elizabeth Warren introduced the rule in the book, All You're Worth, the ultimate lifetime money plan, which she co-authored with her daughter. Instead of trying to follow a complicated, crazy number of lines budget, you can think of your money as sitting in 3 buckets. 1. Costs that don't change, fixed, 50. It would be nice if you didn't have monthly bills, but the electricity bill cometh just like the water, internet, car, and mortgage or rent bills. Assuming you've evaluated how these costs fit into your budget and decided they are musts, there's not much you can do other than pay them. Fixed costs should eat up around 50 of your monthly budget. Discretionary money, 30. This is the bucket where anything within reason goes. It's your money to use on wants instead of needs. Interestingly, most planners include food in this bucket because there's so much choice in how you handle this expense. You could eat at a restaurant or eat at home. You could buy generic or name brand, or you could purchase a cheap can of soup or a bunch of organic ingredients and make your own. This bucket also includes a movie, buying a new tablet, or contributing to charity. You decide. The general rule is 30s of your income, but many financial gurus will argue that 30's much too high. Financial goals. 20. If you're not aggressively saving for the future, maybe funding an IRA, a 529 plan if you have kids, and of course contributing to a 401k or another retirement plan if possible, you're setting yourself up for hard times ahead. This is where the final 20 of your monthly income should go. This funding is essential for your future. Retirement funds like IRAs and Roth IRAs can be set up through most brokerages. If you don't have an emergency fund, most of this 20 should go first to creating one. The percentages of the 50-30-20 rule should be applied to your after-tax income, which is your take, home pay. Another budget strategy, Dave Ramsey's method. Financial guru Dave Ramsey has a different take on how you should carve up your cash. 2. His recommended allocations look something like this, expressed as a percentage of your take, home pay, charitable giving, 10, savings, 10, food, 10-15, utilities, 5-10, housing, 25, transportation, 10, medical health, 5-10, insurance, 10-25, recreation, 5-10, personal spending, 5, miscellaneous, 5-10. About that emergency fund. Beyond your monthly living expenses and discretionary money, the major portion of the cash reserves in your bank account should consist of your emergency fund. The money for that fund should come from the portion of your budget devoted to savings, whether it's from the 20 of 50, 30, 20, or from Ramsey's 10. How much do you need? Everybody has a different opinion. Most financial experts end up suggesting you need a cash stash equal to 6 months of expenses. If you need $5,000 to survive every month, save $30,000. Personal finance guru Suze Orman advises an 8-month emergency fund because that's about how long it takes the average person to find a job. 3. Other experts say 3 months, while some say none at all if you have little debt, already have a lot of money saved in liquid investments, and have quality insurance. Should that fund really be in the bank? Some of those same experts will advise you to keep your 5-figure emergency fund in an investment account with relatively safe allocations to earn more than the paltry interest you'll receive in a savings account. On the other hand, the recent months may have reshaped your thoughts on what feels safe. The main issue is that the money should be instantly accessible if you need it. And also, remember that money in a bank account is FDIC insured. If you don't have an emergency fund, you should probably create one before putting your financial goals savings money toward retirement or other goals. Aim for building the fund to 3 months of expenses, then splitting your savings between a savings account and investments until you have 6 to 8 months worth tucked away. After that, your savings should go into retirement and other goals, investing in something that earns more than a bank account. How much money should I keep in my savings account? How much money you should keep in a savings account depends on your budget. Savings accounts are designed to receive deposits rather than frequent withdrawals. In fact, you're generally allowed no more than 6 withdrawals a month from a savings account. They provide you a place to put money that is separate from your everyday banking needs, such as building an emergency fund or achieving a big savings goal like a dream vacation. However, amid the financial strain of the COVID-19 pandemic, the Federal Reserve introduced an interim rule so that banks no longer have to limit savings account withdrawals to 6 times a month. Instead, customers may make an unlimited number of transfers and withdrawals from their savings. Banks are not required to implement this change, so check with your bank for details. 4. How much money should I keep in my checking account? Checking accounts are designed to handle many transactions, such as paying bills or withdrawing cash you need on hand for daily expenses. The amount of money in your checking account should be enough to pay your monthly bills, withdraw cash for other expenses, and so that you don't get hit with overdraft fees. It should also include a buffer. David Ramsey recommends that the amount of the buffer should make you feel comfortable, but also not be an amount that would tempt you to overspend. 5. The bottom line. Federal Reserve data from the July 2020 report on the economic well-being of U.S. households revealed that 30s of Americans said they would struggle to come up with $400 to pay for an unexpected expense. 6. While that's a slight improvement from the report on April 2020 when 30/60s said that they would struggle, it still doesn't leave much room for saving. Most financial gurus would probably agree that if you start saving something, that's a great first step. Plan to raise that amount over time. 7 places to keep your money. Wary of banks in the stock market. Consider these alternatives. Mistrust toward banks and other financial institutions prompts more fearful individuals to seek alternative venues to park their capital. Others may be avoiding the banks on principle, given their participation in the reckless lending that led up to the housing bubble bursting and triggered the Great Recession. Of course, after last year's wildly volatile stock market, banks have started looking safer. But all the same, it's worth looking at these 7 alternatives. One, in particular, is considered the safest place to keep cash. Key takeaways. The FDIC protection for deposits makes banks look appealing in difficult times. But there are alternative places to put money. Federal bonds are considered very safe, but have very low returns. Real estate can produce income, but can be risky. Precious metals, especially gold, offer an alternative to stocks and bonds. Luxury assets are tangible, but lag stock market returns. Hidden cash isn't secure and loses value over time because of inflation. Businesses are another place to put money, including farms. Cryptocurrency is a new alternative, but comes with its own risks. Where do banks invest their money? Banks offer their customers a place to stash their cash safely for a modest return in interest. In turn, the banks invest that cash, aiming for higher returns. First and foremost, they lend it out to businesses and consumers as loans, making a profit from the interest payment. They also make money on the fees they charge their customers for various services. In addition, banks invest a portion of their money directly in assets such as real estate, bonds, and stocks. Note that today's banking giants have investment banking divisions as well as commercial banking services. That's a whole separate revenue stream that involves financial management and consulting services for corporates and wealthy individuals. Why keep money outside of the bank? The website for the Federal Deposit Insurance Corporation, FDIC, states that no depositor has ever lost a penny of insured deposits since the FDIC was created in 1933. 1. But FDIC insurance only covers $250,000 per depositor per FDIC, insured bank per ownership category. This applies to both the initial principal and any interest earned. 2. Meanwhile, investments in the FEFE 500 index have yielded an average return of about 80 over the past 60 years. But the long-term record for solid returns in the stock markets is dotted with downturns that shake the confidence of some investors. Most stock indexes dropped by 4 to 6 overall in 2018, for example. That was the worst record in 10 years until we got to the market drops triggered by the economic crisis. If you're still looking for alternative places to park your money, here are 7 possibilities. Investments in stocks and bonds are not covered by the FDIC. 1. Federal bonds. The U.S. Treasury and Federal Reserve would be more than happy to take your funds and issue you securities in return, and a very safe one at that. A U.S. government bond still qualifies in most textbooks as a risk-free security. Unfortunately, many individuals and institutions already know that and have entered the bond market ahead of you, which has bid bond rates to very low levels in this time of crisis. On April 9, 2020, the yield from a 10-year Treasury note was 0.73, an all-time low. If the low rates don't deter you, Government bonds are one of the safest places to keep cash. 3. 2. Real estate. In disquieting times for the banks and the stock market, the allure of real estate investment can be strong. Become a landlord. Put down some of your principal on a property, fix it up a bit, rent it out, and have your tenants pay off the mortgage. Or if you're interested in a shorter-term opportunity and have more experience, maybe try flipping houses. Done right, real estate can have a huge financial upside. Yet it can also be a risky and sometimes fickle investment. True residential and diversified real estate investments have averaged about a 10th return in the past 20 years, which is slightly better than the SEP 500 in that period. But real estate can also be an unreliable investment, especially in the short term. An extreme example is the housing bubble that burst and led to the Great Recession. The global economic downturn that began in 2007 resulted in millions of people losing their jobs and homes, resulting in a housing market crash. It's unclear how the current economic situation will ultimately affect the value of real estate. The huge hit to the economy and employment will likely limit buyers' ability to come up with cash and desire to part with it. On the other hand, sellers who really need to sell may be willing to settle for lower prices. And relocations due to people who started working from home, leaving cramped, expensive city housing have helped suburban and exurban regions in some parts of the country while lowering values in some cities. 3. Precious metals. One doomsday scenario in which financial markets cease to function holds that gold, silver, and other metals, such as platinum or copper, will continue to retain their value, if not appreciate. The likelihood of having to return to a barter system with physical goods is minimal, but it may make sense to hold a certain percentage of your assets in this form. For one, precious metals have historically provided a low or negative correlation to other asset classes like stocks and bonds, which is to say, when those investments go south, metals are unlikely to follow, at least very far, and may even increase in value. 4. Luxury assets. This category of tangible assets encompasses fine art, cars, watches, diamonds, and other jewels, and just about anything that qualifies as a collectible. In their favor, they're objects that can be touched and seen compared to a bank account statement that could take time to collect on if the financial institution that housed it ceases to exist. That said, Lux investments are hardly a sure bet. While data on their historical returns are elusive, they're generally thought to have lagged stock market returns while having periods of rapid appreciation due to either strong financial market performance or periods of popularity, which increases underlying demand and resulting prices. 5. Cash hidden away. Although stuffing money under your mattress has become a cliche, it unquestionably keeps your funds close at hand, if not necessarily secure. You could, of course, also hide your assets in a safe deposit box or safe. Again, this method probably qualifies only for a doomsday scenario, or for times of a short-term liquidity crunch. Even then, keep only a small stash, not least because inflation steadily erodes the value of currency over time. In a deflation, the opposite is true, of course. Fast facts. Cash held in a safe deposit box is not insured. 6. In a business, perhaps a farm, buying a business can ensure a return on your investment, provided, of course, that the enterprise generates a profit. In very bad times, of course, businesses suffer as well. A farm can be a particularly tangible business, if not a reliably profitable one. You don't necessarily need to get our hands dirty either. With a so-called investment farm, you hire staff to handle the actual agricultural operations. Owning farmland is a good fit with a survivalist mindset too, since the land can produce food on the off chance of a global calamity or meltdown of the global financial system. 7. Cryptocurrency. Cryptocurrencies are another alternative investment option. There are a number of choices. Bitcoin is just the best known. So-called cryptos offer individual investors a unique opportunity to get into what is still very much an emerging technology. Of course, this is also a high-risk, high-reward opportunity. For example, after soaring to stratospheric highs, Bitcoin lost about 3/4 of its value in 2018. You shouldn't invest much, or any, funds in cryptocurrency that you'll rely on for your future. Yet most analysts believe these alternative currencies are here to stay and brave. Investors may want to pitch a stake on the off chance of hitting it big with one of them. The bottom line. Although the subprime mortgage meltdown is more than a decade old, the financial industry is still looked upon with some suspicion these days. at least by some skeptics, and the stock market may be no less of a concern for such people, particularly in the wake of the unprecedented ongoing volatility the markets have experienced. For the especially wary, the above alternatives to a traditional bank or stocks may make sense for at least a percentage of net worth. But given their risk, none should be too big a component of your investments.